Now that we know what each financial statement tells us, we can use this information from the statements to determine the firm's free cash flow. First, we need to introduce some additional terminology. Net cash flow, or NCF, is equal to the net income minus non-cash revenues plus depreciation. So if you recall back when we were looking at our statement of cash flows, we added in depreciation because it was a non-cash expense. Well, that's what we're doing here. We're subtracting non-cash revenues and adding back in depreciation because it's a non-cash expense. Usually we assume that non-cash revenues are zero, so our full formula for net cash flow would just be equal to the net income plus the depreciation. Operating cash flow, OCF, is equal to our earnings before interest and taxes times 1 minus the tax rate plus depreciation. So again, where EBIT is earnings before interest and taxes, and T is our tax rate. Operating cash flow doesn't include any tax savings received by the firm's use of debt financing. So we know that when the firm uses debt financing, it creates a tax shelter, while operating cash flow ignores that. Net operating working capital, NOWC, is equal to cash plus accounts receivable plus inventory minus accounts payable minus accruals. Or if you recall, cash plus accounts receivable plus inventory is referred to as current assets. Accounts payable plus accounts accruals plus notes payable were our current liabilities, but we only want the current non-interest liabilities to subtract from our current assets. So we can call the accounts payable plus the accruals current non-interest liabilities. And then we get this new equation for net operating working capital, which is just our current assets minus our current non-interest liabilities. Gross fixed assets, GFA, and depreciation throughout the year, DEP, well, we know what these mean. These are just from our balance sheet. Gross fixed assets are the total amount of fixed assets that we have, the book value of our fixed assets. Depreciation, we have depreciation expense each year because we're lowering the book value of our fixed assets as we use up value as they degrade over time. And our net fixed assets, NFA, is also from our balance sheet in this formula. Gross fixed assets equals net fixed assets plus our accumulated depreciation, or net fixed assets equals gross fixed assets minus our accumulated depreciation. Again, both of those are from the balance sheet, but we just need to be familiar with the terminology. Total operating capital, TOC, is equal to our net operating working capital plus our net fixed assets. Net investment in operating capital, NIOC, is equal to our change in our total operating capital, which we can also write, since total operating capital is net operating working capital plus net fixed assets, we can write net investment in operating capital equal to the change in net operating working capital plus the change in net fixed assets. Our gross investment in operating capital, GIOC, is equal to our net investment in operating capital, and IOC, plus the depreciation expense for that year. And since our net investment in operating capital, we had that formula above, this change in net operating working capital plus a change in net fixed assets, well, we can write gross investment in operating capital equal to the change in net operating working capital plus the change in net fixed assets plus our depreciation expense. Those are just two ways of writing the same thing. And we can also write, since we know the change in net fixed assets plus our depreciation is equal to our change in gross fixed assets, we can simplify it once more and write our gross investment operating capital as this last line, just equal to the change in net operating working capital plus a change in gross fixed assets. Our earnings before interest and taxes, EBIT, we went over this when we went over financial statements. Our net operating profit after taxes, NOPAT, is equal to our earnings before interest and taxes times 1 minus the tax rate. And again, we know our operating cash flow was our earnings before interest and taxes times 1 minus the tax rate plus depreciation. So now that we have a new term for earnings before interest taxes times 1 minus the tax rate, we can write operating cash flow as NOPAT plus depreciation. So now that we have this information, we can define free cash flow a couple of ways. So free cash flow, basically we're talking about the money that the firm has left over after they've paid all their expenses, their operating expenses, they've paid off their investors. What do they have left that they could still distribute to their equity holders, their their equity investors, their capital suppliers, at the end of the day after they've accounted for all their expenses. So the first way is the free cash flow equals the operating cash flow minus the gross investment in operating capital. Well, we know the gross investment in operating capital equals this equation, so we could substitute that and we could rewrite it like this as well. So free cash flow equals operating cash flow minus the changes in net operating working capital minus the changes in gross fixed assets. Alternatively, we could say the free cash flow is equal to the operating cash flow minus the gross investment in operating capital, and we can rewrite operating cash flow as NOPAT plus depreciation, and we can rewrite gross investment in operating capital as net investment in operating capital plus depreciation. And we can see if we distribute the minus sign, the depreciation expenses cancel out, so we're left with free cash flow equal to NOPAT minus net investment in operating capital. And net investment in operating capital is the change in net operating working capital minus, plus the change in net fixed assets, so we can rewrite free cash flow as NOPAT minus both of those together. So there's a bunch of different ways to get at free cash flow. It just depends on what you're given. You just need to know what all the terms mean so you can go down the right path to finding free cash flow with the information that you're given. So let's look at an example. Suppose sales are $225, cost of goods sold is $100, and suppose there was $50 of other expenses, and depreciation and amortization are $25. So amortization, we haven't talked about that yet, but it's basically depreciation on intangible assets. So remember, we said depreciation was if you buy a plant and it has a lifespan of 10 years, well, you want to match what your plant is generating each year with what it's costing you. And so you depreciate the life over 10 years. Amortization is the same thing. It's just you're depreciating intangible assets like loans as opposed to actual physical things like plants or property or equipment. So let's just assume that both depreciation and amortization are $25. Also assume that the change in net operating working capital is $20 and there is $45 of gross investment in capital. If the tax rate is 40%, what is the firm's free cash flow for the year? Well, since we have enough information to find NOPAT, and we're given the change in net operating working capital and the change in gross fixed assets, we'll use the following equation for free cash flow. And the question tells us that there's a $45 investment in gross capital. That's exactly what the change in gross fixed assets is asking for. It's asking for how our gross fixed assets account changed over the past year. So if we're told we invested $45 into capital, that's affecting this gross fixed assets category. So we want to use this equation. Free cash flow equals operating cash flow minus the change in net operating working capital minus the change in gross fixed assets. First, let's find the operating cash flow. We know that operating cash flow equals EBIT times 1 minus the tax rate plus depreciation. Earnings before interest and taxes, EBIT, is the $225 in sales minus the $100 in cost of goods sold minus our operating expenses of $50 minus our depreciation and amortization of $25. We get 50 for EBIT. This goes back to the income statement. This is how we find EBIT. And now we can find operating cash flow. We just multiply EBIT of 50 times 1 minus the tax rate. Tax rate is 0.4. And we add back in the depreciation expense of $25 because it's a non-cash expense. That gives us the operating cash flow of $55. Well, we're told that the change in net operating working capital is $20 and the change in gross fixed assets is $45. So our free cash flow is equal to, again, our operating cash flow minus our change in net operating working capital minus the change in gross fixed assets, or $55 minus 20 minus 45, and we have negative $10 for our free cash flow. And that's the end of part 2.